European central banks follow the steps of Japan in attempting to drive inflation. Donald Trump unsurprisingly responds, and Democratic presidential candidate Beto O'Rourke wants to take away your financial autonomy. This is Worldwide Economy. I hope everyone's had a great week. I definitely have. I've brought in some changes to the show. Essentially, instead of the Nasdaq Composite Index, I'm going to be talking about Euro Stock 600. So that's it's a mix of essentially large, mid, and small cap firms within 17 European countries, just to give a bit more diversity. Anyways, let's get right into it. S&P 500 rose 0.77%. Euro Stoxx 600 rose 1.11%, and WIG20, the 20 biggest Polish companies, rose 3.1%. So essentially, we're on top, we're winning the game, and I'm very happy. Let's see if we can keep the streak going. I sometimes feel like the WIG20, our Polish market, doesn't always seem to be in any coherence with the rest of the world. I mean, sometimes the American kind of stock markets go up a lot. In Poland, we kind of take a few hits, but nonetheless, this week we're up 3%. I'm very, very happy. So let's just get right into the main story of this week, and that is the European Central Bank's quantitative easing, or essentially further quantitative easing policy. That is, in other words, expansionary monetary policy. So Mario Draghi, I'm not sure how to exactly pronounce his name. He's the current president of the European Central Bank. He has now announced further plans of quantitative easing earlier this week. So essentially, this comes in the form of an interest rate cut and increasing the money supply in the economy or in the European economies through more bond buybacks valued at around 20 billion euros every month for supposedly an unlimited amount of time. So until the end of eternity, that's basically the amount of time or essentially the time period throughout which the European Central Bank is going to keep buying back bonds. So essentially when the European Central Bank, or any central bank for that matter, buys back bonds, they pay consumers back, and that increases the money supply. Because before, you had the European Central Bank with the money and someone else with a bond, which represented debt. Now it's switched around. There's more money supply in the economy. Interest rate cut of 10 basis points, so that's 0.1%. It's gone down from minus 0.4% to minus 0.5%. So we're going further into negative territory. And it's caused a lot of debate. I'll give you my opinion on this in a second. But essentially, by increasing the money supply, the European Central Bank is attempting to increase liquidity in the markets. That is essentially the reason for monetary policy or expansionary monetary policy, and essentially to incentivize investments, lending, this kind of general economic activity within an economy through this lower interest rate. Since essentially with the interest rate, it is the price for borrowing money. So if I go out to borrow £100, the interest rate is essentially, let's say it's at 2%. It's gonna be £2 or whatever dollars that I just said that I'm gonna have to pay back on top of my initial loan. But since it's already negative, just how much juice can the kind of European Central Bank squeeze out of the monetary policy lemon? So essentially, some people might be wondering about what a negative interest rate actually does. What does this policy mean? Because, okay, well, if in a positive interest rate kind of policy, we have to pay back more, what happens in the negative one? Do the banks pay us? What happens? That's not exactly the case. That would be pretty stupid, pretty crazy. But anyways, someone does have to pay back someone else. A negative interest rate policy forces financial institutions to pay interest on all excess cash reserves above, obviously, the reserve amount that they're legally required to hold. So in various countries, obviously, depending on the central bank's kind of laws, each bank, kind of commercial bank, is going to have to be holding a certain amount of cash reserves in case of something happens. So that might be a certain ratio or a percentage to the money they're lending out. So let's say if you're lending out, or out of all your cash, depending on how much you're lending out, you have to keep a proportion of that in proportionate amount in your cash reserves, or it might be just like, let's say, $100 million, whatever. It comes in different forms and sizes, either a ratio, percentage, or just a set amount. But essentially, yeah, so the financial institutions, the commercial banks, have to pay back the central bank amounts of money in respect to how much they're keeping in their cash reserves instead of lending it out. So what does this mean? Well, this heavily disincentivizes banks holding onto cash and essentially promotes lending within the economy. So often, especially lower interest rates, what happens is that banks just prefer to keep money flowing. Even at a loss, if this kind of loss is less than the cost of the, you can say, penalty to the European Central Bank. So let's say if they have to pay back 1% or in this case 0.4% of the, or now in this case, sorry, 0.5%, because it's obviously being cut. If the banks have to pay back 0.5% on the cash reserves that they're keeping above what they have to legally keep, then they might as well just kind of lend out the money at a rate that is more beneficial. So instead of losing 0.5% to the central bank, they're going to lose 0.3%, 0.1%, or just, 0%, whatever it might be, whatever the bank decides, in essentially on the other side, on when they lend out money. But essentially, it kind of begs the question, at what point does further quantitative easing do more harm than good? Because obviously, as we can see now, banks are in between a rock and a hard place, right? They're either going to pay the penalty to the European Central Bank for holding onto money, or they're just going to keep lending money at essentially a loss. Well, over the past few months, Deutsche Bank, if you have heard, has been releasing quite negative news regarding layoffs and the general decrease in business activity. And essentially, since the European Central Bank's introduction of negative interest rate, which was in June 2014, I believe, the performance and returns of American versus European banks have diverged. So I've actually got a graph or diagram in front of me, which is actually up on my weekly column. I released it just a few minutes ago on investingintellect.com. As you know, might not know, worldwide economy, I will never be able to pronounce this properly, comes in weekly columns as well as the kind of podcast or video version that you might see on YouTube. So essentially, if you head over to investingintellect.com, you can see the kind of graphs that I'm looking at. It essentially shows the 12-year cumulative total returns of banks, specifically JP Morgan versus a bunch of European banks. And whereas JP Morgan, an American bank, has kept going up, its returns have been increasing because of the nice kind of interest rates in America and just in general the economic activity, European banks have been suffering. And obviously, since now we have had negative interest rate, I was about to say investing intellect or whatever, negative interest rate for about 5 years now, actually, a bit over 5 years, it really, really hurts the long-term return potential of these banks. I mean, it might drive them out of business because, like I said, they're stuck between a rock and a hard place. They're either going to pay the penalty or they're going to get crappy returns when lending to consumers if they won't even lose money at all, to be honest. Anyways, like I said, interest rates are the price you pay for borrowing money, but also the returns banks get for lending it. That's kind of a summary of what I've just been talking about. So essentially, when the benchmark interest rate reaches levels far below inflation, when the interest rate is zero, at zero, or below zero, like we have in a European kind of union right now, it essentially hurts the performance of European banks. Whereas, like I said, JP Morgan's returns have been continuously breaking record highs. And also, another kind of talking point, obviously aside from just the banks and their returns and the business activity within the bank sector, comes also from a kind of more political nature in the sense of higher political and economic integration within Europe. So obviously, as we know, the European Union is a collection of various countries, much like the US is, just at a much higher, more developed level. So obviously the US is a mixture of 50 or 51 states, don't kill me, I don't remember specifically, and the European Union has 28 members. However, the European Union, unlike the US, is actually a lot younger, obviously when you're comparing the two. So the blanket policies that it kind of does implement, the European Central Bank, like the monetary policy that I was just talking about and the kind of header of the story, is that it will not affect European countries, equally. What does this mean? Each country is going to react in a different manner. For what reasons, I'm going to explain now. So, for example, richer countries which hold larger reserves, like, let's say, France or Germany, larger cash reserves in the banks, they will see a larger reaction to this kind of policy than some poorer UE members in the East, let's say Poland, Hungary, whatever. In essence, it is a topic of interest due to the, like I said, kind of economic incoherence within the EU member states, because essentially what happens is that France and Germany and commercial banks within that area have got more to lose because of their larger cash reserves. So when they're, when you have to pay a percentage, there's more at stake at a kind of absolute term in terms of however many euros that they might lose if they keep holding onto their large cash reserves. Whereas, Poland, Ukraine, more Eastern countries, their banks aren't as rich in some cases. I mean, as rich. They let's just say they don't hold as many cash reserves as the other countries. So obviously they might have to just lend a bit more, or keep lending a bit more. Whereas French and like I said, German banks will see a larger kind of outflow of money in terms of more lending, if that makes sense. Anyways, the Dutch Parliament responded to Draghi's don't kill me again, quantitative easing policy, saying that this will harm Dutch pension funds actually, since it's all about saving and investments and kind of letting this money appreciate over a certain period of time. I should make a good point about this in just a second, because lower interest rates hurt saving. They hurt savings because when your money sits in your bank, it doesn't appreciate. It's not worth for you to keep it in the bank, essentially. Moreover, German newspaper Bild has also accused Draghi of sucking dry the bank accounts of German savers through the negative interest rate. Again, because you keep your money in the bank, but it doesn't appreciate. It actually goes down in value. I mean, down in literally nominal, real terms, both. Essentially, just to kind of go back on the Dutch pension funds kind of point, the reason why it hurts Dutch pension funds, this kind of very low interest rate, is that essentially imagine yourself as a saver. This is a very basic example, but it kind of proves the point. And your interest rate, let's say, is sitting at 4% right now. If your country decreases your interest rate to, let's say, 2%, you as a consumer, as just a person, as whoever's managing money and trying to make it appreciate and obviously grow in value over the long term, you're going to have to essentially double your savings. So you're going to have to double the amount of money you're saving each month, inputting, because it's going to appreciate at half the speed, or whatever, at half the speed at a 2% rather than 4%. So this is the reason why it hurts pension funds and people's bank accounts, because obviously their savings, or they're saving less, their savings are appreciating less. So in a sense, they will have to be saving more to reach their retirement goals, which is kind of the idea of these pension funds. And so even though lower interest rates and expansionary monetary policy from that kind of perspective aims at disincentivizing saving, it might actually end up doing something quite the opposite. It's pretty crazy. Anyways, this is just an extract from my article that I wrote, my column. I think it's very interesting. I use a cool metaphor which actually makes a lot of sense. Anyways, the diversity of European Union, in the sense of economic terms, the economic diversity of European Union imitates a hydra dragon. By tackling weakening inflation and cutting interest rates, 28 more problems arise. So essentially, as you know, the hydra dragon is kind of the mythological creature from, I think maybe it was Greek mythology, I don't remember, where you cut off one head and two more grow back in its place. Well, due to the EU having 28 member states, and you trying to tackle inflation and cutting essentially the interest rates, you're going to get 28 more problems arising, because like I said, each country is going to be reacting in a different way. As you see, Dutch pension funds, German normal savers, the kind of Eastern everyone's going to have a different effect, in some terms potentially even an adverse effect. Personally, the further kind of quantitative easing seems disproportionate to current economic conditions. I mean, the monetary policy lever can't be moved down much further without breaking off the handle, So it kind of begs the question, what's going to happen when the recession occurs, right? Everyone's always talking about the recession. It's going to come next year. It's going to come in the next 6 months, in the next 24 months. But when it does come, what's going to happen? Are we going to have interest rates of negative 3%? That's crazy. Inflation, in my opinion, has to be tackled from a different perspective. Potentially fiscal stimulus, it's been said to be the way to go, yet the European Central Bank has simply gone back to further blowing asset bubbles with low interest rates. And it's been proven in the recent rally in Euro Stock 600 index. In that index, like I said, it's gone up over 1% recently. There's been a rally in this. And why has the rally occurred? Because of cut interest rates. It's not like businesses have suddenly started doing well. I mean, maybe they will in the future. However, looking at Japan and how they tried to tackle inflation for 30 years with lower interest rates, it doesn't seem likely. So what does it mean? It means that the value of these businesses isn't suddenly going up, the price has. And the difference in the price and the value is a bubble. It's essentially the false allocation of resources within our economy. The money's not going where, to the places where it should be going. So it's a big problem. It's a really big problem. And we're already for many years in the negative interest rate territory. So some people fear that when the recession does happen, I mean, we'll see. I mean, with fiscal stimulus in that sense, a lot of fiscal stimulus is going to be required to fuel back the economy. That's going to grow incredible amounts of debt. And the Eurozone, the European Union, will experience, let's say, at the very least, a severe weakness, economic weakness. Anyways, let's move on. Trump's tweet of the week, 14th of September, that's the date today. So this week, essentially, we discussed the probability of 0% interest rate in the US. How great to see this in the back of what's been happening in the European Central Bank, essentially with the European Union. So this week, I picked out Trump's kind of tweet from his Twitter, and I'll give you a quick quote from Donald Trump himself. I'm going to try the accent, not just yet. I'm not that good at accents. The Federal Reserve should get our interest rates down to 0 or less. Interest rate costs could be brought way down. Anyways, I talk about this and more, obviously, in my Trump's Tweet of the Week column this week. And again, I kind of talk about the savings and how people have to kind of save double when your interest rate halves. So are you really disincentivizing savings? I don't know, man, because if someone's got a retirement goal, they've got their pension, they've got whatever, they're going to try and reach it. So if they have to end up saving twice as much, well, then it's an adverse effect. Anyways, Japan and now the EU have become, like I said, infamous examples of how expansionary monetary policy and lower interest rates just don't cut it when it comes to stimulating inflation. You can head over to investingintellect.com to read more about that. For now, I'm just going to give you a quick kind of peek at what's been happening on, obviously, a pinch of politics this week. So that's essentially another part of my worldwide economy column. So Beto O'Rourke, he's a Democratic presidential candidate. He's been a strong advocate of taking away guns from the hands of American people. And his kind of latest strategy on doing so is to limit your financial autonomy. That's pretty funny. So I've seen him in many interviews talking about how there's no way he will not, as president, take away the guns from the American people. And obviously, whether you're pro or anti-gun, you have to look at it from someone else's perspective. So let's say I personally, I'm anti-gun. I've lived in Poland, I've lived in the UK, I've never lived in a place where people walk around with guns or guns are legal at all. I've kind of been brought up in this area and I don't see the need for having guns in most cases. So essentially, I have to look at it from someone else's point of view. Someone who is pro-gun, someone who likes their guns, maybe obviously likes the kind of the safety that comes along with it. That's also a main argument, is the idea of protecting yourself. So I have to look at it from their perspective. Otherwise, it's just unfair, because I would, let's say, like to ban guns, but what does it mean to someone else? Essentially, what does this mean? So O'Rourke, first I want to say what he's proposed. O'Rourke, I took the story out of his from his Twitter, which I found this week. Anyways, let's get to it. O'Rourke has proposed a move to a centralized financial system wherein the government will decide what you can and cannot spend your money on, forcing companies to follow a political agenda and side of a certain political ideology. So I'm going to read from his Twitter right now. Banks and credit card companies must: 1. Refuse to take part in the sale of assault weapons. 2. Stop processing transactions for gun sales online and at gun shows without background checks. 3. Stop doing business with gun and ammo manufacturers who produce or sell assault weapons. What does it mean? Well, you can only use your credit card in a certain way. The company can only process certain transactions. It's essentially a centralized system. It's essentially an authoritarian regime that is trying to get America into. And I'm strongly against that, because even though I'm anti-gun, let's say, I'm also against a lack or a fall in autonomy, because that's essentially what it means. It's essentially, it gives a government the power to become essentially more centralized and tell you what you can spend your money on, tell you what you can buy, tell businesses what to produce or not. So that's, in these kind of very controversial or polarizing issues, people have to look at it very critically. What does this mean? It doesn't mean, oh, he's trying to ban guns, that's good. And I say it's good because it's not happening to me. But when it comes around and now, credit cards only service these items, that I'm interested in, and now Beta O'Rourke starts going at the companies that I like, well, then we're in a bit of a pickle. But then you're the one in the first place who actually enabled it when it was happening to something that you don't agree with, something that was, kind of essentially something that you agreed with, and you only disagree with it when it starts happening to you. Anyways, that's a pinch of politics for this week. I hope you have found the podcast, video, article, whatever the hell you're listening to or watching right now interesting. If you have any comments, any feedback, if you want to start a dialogue with me, I'll be more than happy to answer you on my email or investingintellect.com. You can find all my contact details there, on my LinkedIn, whatever. But anyways, thank you guys for watching, listening, and reading. I hope you have a great week ahead, because I hope I will. I'll see you soon.